The Co-operative is a household name here in the UK. From food to funeral care to banking, the company is known for its ethical take on business. However, recently it's been in the news for less positive reasons. I'm joined by CAS Professor Andre Spicer to discuss. So first of all, Andre, can you give us a bit of background on the company?
The Co-op was founded in the mid-19th century by a group of local people who were sick of buying adulterated products from large industrialists. So they decided to form a business of their own. This was a member society, and it grew rapidly over a period of 150 years. Up until the financial crisis, and then really the bank took off significantly because people were looking for a viable alternative to the mainstream banks. So the result is that they grew the number of deposit holders, but also they began to take over businesses. So for instance, they took over the Britannia Building Society and were looking into taking over part of Lloyd's Group, over 600 branches.
And what are the problems they've now run into?
Once it took over the Britannia Building Society, it discovered that there were a number of toxic loans on its balance sheet, largely from housing. The second thing is it tried to overreach itself by taking over the Lloyd's branch. The third problem is that the government had brought into place new regulations which required the bank to hold significantly more capital on its balance sheet. The result is that a £1.5 billion black hole opened up on its balance sheet.
And how have they gone about sorting that out?
What's happened following the financial crisis is banks have been bailed out. That means that the government has stepped in and provided taxpayers' money to save the bank. Clearly, the public isn't interested in doing that anymore. So they've come up with a new solution, which is called bailing in a bank. That involves essentially taking bondholders' money and turning that into equity or shareholders. So the result is that the balance sheet is propped up, there's more equity on it, but the ownership of the bank effectively changes. So the bank's no longer completely owned by the Co-op Group. It's 30% owned by the Co-op Group and 70% owned by bondholders, many of which are American hedge funds.
And can the company be true to its ethical roots when it's effectively being run by hedge funds?
On the day the announcement was made, the bank decided to codify its ethical framework. So for instance, not investing in arms companies. But on this very same day, the bank also announced over 1,000 job cuts. I think this begins to point out some of the kind of contradictions which the bank is going to face in the future.
So what are the upsides to this situation?
The upside for the taxpayer is that they didn't have to engage in an expensive bailout. The upside for the bank is that organisations which are owned by hedge funds tend to be slightly more efficient. The hedge funds tend to be in it for the medium term, and finally they tend to pay their CEO less.
And what are the drawbacks?
I think the bank is probably going to face a number of its customers leaving. So many of these people want to be members of a co-op, not customers of a corporate-owned bank. The second problem is for the wider banking system. So the result of the hedge fund becoming more like a mainstream bank is that there's actually less variety. Now this is important because A, it provides less choice for customers, but also it has an effect on the other banks. So when co-op banks tend to be in a system, both those banks themselves are more efficient, but their mere presence actually makes their private sector rivals have to be more efficient as well.
Andre, thank you for your time.
Thank you.